Welcome to the Retirement Roadmap by SHP Financial, a podcast empowering today's retirees and pre-retirees to make well-informed financial decisions that will help you spend more time living and dreaming than worrying and wondering. Join me, Matthew Peck, along with my co-hosts, Derek Gregoire and Keith Ellis, as we share actionable financial strategies and insights, as well as interview top thought leaders in the world of finance, accounting, and estate planning. This is all aimed at preparing you for the retirement you've always dreamed of. Our high-quality holistic planning process has helped thousands of families retire and create what we like to call the ripple effect. The Retirement Roadmap is your guide to financial freedom. Are you ready to get started? Let's go. Welcome, everyone, to another edition of the SHP Financial's Retirement Roadmap podcast. I'm your host today, joined by Keith Ellis. Derek is, as always, kind of finding his own way, probably on a golf course right now, but or probably filming a nice TV show somewhere.
There we go.
Too. Right, absolutely. He's out there doing his own thing, which is a great thing too. As they say, teamwork makes the dream work here at SHP. So today we sort of have a very special guest, and in an effort to continue to remind and to reinforce all the different services and all the different alliances that SHP has on behalf of their clients, we wanted to bring on Nathan Hartseil of Main Street Home Loans. And so what Nathan does is works with our existing clients and obviously other clients as well, to help navigate the mortgage industry, rising interest rates, when to refinance, are we buying a new home, what are jumbo loans and ARMs, adjustable rate mortgages. And specifically, we wanted to bring Nathan on because it's a whole new environment now. We haven't lived through or been through a rising interest rate environment in close to 2 decades now. And so we're going to ask him questions like, what type of advice are you giving your clients right now during this types of environment? What type of impact have we seen on the overall real estate market with the interest rates rising by Powell? And also, how does that work? I mean, when Chairman Powell says, "Okay, hey, we're going to raise interest rates," has that been priced in? I mean, should people be waiting until interest rates stop rising to start to act, or those are just all questions that we have. But at the end of the day, by working with other professionals and working with people that are experts in other fields, we just feel that we're doing the best we can on behalf of SHP clients, or if you're not an SHP client and if you do have an advisor, just really making sure that they are also partnering with experts in every single field, because you're going to need a team. The world is much more complicated than it's ever been, and it's not getting any less complex. And surrounding yourself with good, solid teammates is really how you're going to be able to navigate the world at large. So, without much further ado, I'd like to bring on Nathan Hartseil and welcome to the podcast.
Well, thanks, Matt, Keith, SHP. It's an honor to be here, and hopefully I can shed some light on your questions today.
Yeah, absolutely. And as we always say, hopefully you're okay with the fact that there are no dumb questions. That's okay. So even if when it's like, our listeners will be like, wait a second, aren't isn't Keith and Matt supposed to be financial guys? And then we may ask some questions that might not be up to your standard, but we'll.
That's okay. I brought my crystal ball today. So.
Oh, good. That'll be very helpful. Well, then, as I mentioned about being an expert, and certainly obviously you have a lot of experience. So tell us a little bit more about your background, how you got into the mortgage industry, how long you've been doing it for. So just start at the beginning.
Sure. So after high school, pretty much right after I turned 18 years old, I joined the Marine Corps. I was in the Marine Corps for 8 years, 4.5 active, 3.5 reservists. Why I went to college at Eastern Illinois University. Some of you may know Tony Romo. He lived right next door to me at Eastern Illinois University. Jimmy Garoppolo went there too, but he was a little after my time. So after Eastern Illinois University, the financial market was hot. This was probably about 2005, where mortgages in the U.S. were just anybody and everybody was writing mortgages, and it was the day of subprime mortgages, actually, where I started in the industry and moved my way up to Alt-A and then conventional financing. But I started in the industry. My first company was with Encore Credit Corporation, who was acquired by Bear Stearns. So I ended up working for Bear Stearns probably about 2005 to 2007. And I was there when the TVs went wild and Bear Stearns was going under, and everybody had lost everything. And I'm like, where's my profit sharing? Where's my stock options? And I learned the financial industry really quick my first 2 years. Because my second job I got hired was by Lehman Brothers.
all the hits here, huh?
I had worked there for about 2 paychecks. And
did you work for like Polaroid or any other companies that went bankrupt?
I didn't, but I got about 2 paychecks and lost my job again. So here I am in my 20s. Really jumped feet first into the financial industry and felt like I was thinking.
Right.
So I actually went out on my own. I met some really great people. So while the financial service industry took a turn for the worst, I met some good people at both companies that experienced downfall and the loss of their job. Similar like I did, and we went out on our own. And I actually went into commercial for a while, writing feasibility studies on large scale and international commercial products to present to investors for financing. And I did this for probably about 4 or 5 years prior to moving to the great state of Massachusetts and starting my business all over, trying to grab a foothold in a new area while I was familiar with the industry. I'm originally from outside of Chicago, and I must say I felt like that area was a little more devastated at the time, and I had a better success ratio and chance of building a new client base and working with a client base the way I wanted to. Really putting the client first here in the Massachusetts market. So I've been in the Massachusetts market for probably about 10 years now. And built.
Well, I'm sorry to interrupt, Nathan, but go back to that's amazing that the fact that you had that background, like the subprime. So I mean, I know obviously you just started out, right? But did you have any inclination that, oh my goodness, these subprime mortgages are not a good idea? Or were you just like, hey, I was brand new, what else? I'm just selling what they told me to sell. You know what I mean?
Well, a little bit of both, to be honest with you. I better understood, especially working for large financial firms, the way the wheels turned. And as long as there was an investor base, and as long as these loans were being bought and sold or put into mortgage-backed securities, and there was a market, whether it be international market or conventional market, the wheels were turning. They were being bought. They were being purchased. So I looked at it at the time, this was the norm. Now, I have to say, granted, Bear Stearns, Lehman Brothers got a really bad rap from subprime mortgages, but, I was always taught in the industry, if it makes sense, we can find a way to do it. So whether some people were writing loans that just didn't make sense, I've always been that person, like I said earlier, what's best for the client. If I felt that this client could not make this payment reasonably, or, I was going to put somebody into some type of danger or financial hardship, I always put morale over, a paycheck in my pocket.
Yeah, no, absolutely. Which is obviously part of the reason why we're, partnering, to say the least. But also walk me through that too, because just on a day-to-day, right? So because there's underwriters, right? I mean, I guess how much decisions do you make, in regards to what to offer per se? And then obviously all the information gets over to an underwriter, right?
Sure.
So just walk our clients and our listeners through that overall process, and how much is in your hands as the broker versus how much is in some actuary that's somewhere in the basement? Like, how does that work?
No, absolutely. Great question. So I manage the area for Main Street Home Loans. We are a division of NFM, which is a large larger company, and I get a lot of control and I get a lot of free reign, which is great. And part of the reason I hang my hat with Main Street Home Loans, because I feel I do have the expertise in the industry, and they trust me on a day-to-day basis to make the right decisions. That being said, we keep everything local. So I have my own underwriter in office, my own processing team in office, my own closing team in office. All my appraisers are local. While they don't directly work for me, we are our own AMC, which is an appraisal management company. And, so we have protocols in place to avoid any type of fraud or influence, anything like that. Now, I'm not only a broker, first and foremost, I'm a banker. We are a direct lender. So we hold in service, at one point it was over 40% of the loans that we actually originate. We're also a direct seller to Fannie Mae, Freddie Mac, your top 20 banks. We also portfolio our own product via Ginnie Mae products. If there are products that we don't offer, I can broker a product, and we offer some outside the box things that we choose not to do in-house that I broker. But first and foremost, definitely a banker. That it's our money.
And is that different than?
I was going to ask.
Yeah,
Sure.
You go down to the local bank. Like, what's the difference, I guess, from?
So a banker, we're directly lending
Okay.
on our products. Now, whether we portfolio those and service them ourselves, whether we launch our own mortgage-backed security or direct sell to Fannie Mae and Freddie Mac, is kind of our prerogative. A broker, definitely, they don't have their own in-house products. They're not lending their own money. They're taking other products and they're offering those to their clients. So to make money on those products,
there's a little bit of an extra fee in there.
Absolutely.
Okay.
Now they may get a more premium pricing. I'm not saying that the rate's always higher.
Sure.
They may get a more premium pricing, but then they have to add their fee to make money on top of it. And the more fee that they usually add is more of a payday for them. I am not paid off yield spread. So my job is to offer my clients, at least when we bank the loan, the best interest rate available. I'm paid off volume that I do, not adding to interest rate or adding to fees. That's why we have a standard fee across the board for every loan that we originate, and it doesn't change. If you borrow $30,000 or $3 million, it doesn't matter. It's the same flat fee.
Well, which I think too, yeah, and just let's expand on that a little bit too, because interestingly enough, I hear terms like points, and then you mentioned something like yield spread. So, and again, as I said,
sure.
Hopefully questions again, no questions. But how do individuals in your field get paid? Is it points? Is it yield spread? Is it just a flat
Commission.
origination fee? How, and as you mentioned, you just said it was flat as compared to whether you're refinancing a $200,000 home or a $2 million home. It's the same?
Well, that's on the origination and underwriting and processing fee.
Okay.
And there's really no money in that for any lender whatsoever. It actually costs more to originate a loan than we charge on the front end of a loan.
Okay.
So it's kind of just to stay competitive in the market, it's kind of a loss up front if that client doesn't follow through all the way to the end with you. So we have published rate sheets.
Okay.
And with these published rate sheets, people fit into different categories based off credit score, debt to income ratio, amount of down payment. Is it a condo, a single family home, a multifamily home? Is it an investment property? Is it owner occupied, a second home? So there's a multitude that affect interest rates. Lenders make their money, it's called yield spread.
Okay.
So that is the difference between what money is borrowed at and what money is lent at.
Okay.
So our published rates in between what we borrow money at would be a yield spread.
Okay. But you said you don't do that, but other firms do? Or
adding on to the published rates. So
okay.
Yes, which would be like a broker fee, origination points.
Yep.
And points on a loan, like 1 point is 1% of the amount you borrow.
Okay.
So if you ever see your fees when you go to closing and you're borrowing $300,000 and there's 1 point on there, that's costing you $3,000 at closing.
And that does that impact your interest rate, or just more of that's your origination fee?
So a little bit of both.
Okay.
So if you're a broker and you have a broker fee of 1 point on there, that is part of your origination fee.
Okay.
If my published rate is 6.25, but you come to me and you're like, Nate, I got to be in the fives. I need a 5.99. That rate is available. I can get that rate. That is a published rate. However, there is a difference between where we borrow money and our published par rate of 6.25 to that 5.99. So a borrower can pay points to reduce that interest rate. Now, say it's 1 point to get to a 5.99 from a 6.25 on that $300,000 loan. That borrower would pay $3,000 at closing to be able to obtain that lower rate. And my job is to also talk with the client and find out how long do we anticipate you're going to be in this interest rate. Are you buying the house for a year? Are you refinancing? You plan on moving in 6 months? Do we think interest rates are going to improve in the next 6 to 12 months? And if that's only saving $15 to $25 a month in payment, it may not be worth it for that client to pay those points to bring the interest rate down. But if they say, no, Nate, we don't anticipate refinancing. This is our forever home.
Sure.
We're going to be here 20, 30 years. That $20, $30 a month definitely exceeds that $3,000 they're paying. So I guess, we have to correlate with the client to find out risk versus reward.
Goals.
Definitely.
Yeah.
Goals.
Yeah.
Yeah, and let me put it this way. I had no idea going into the call. Again, I mean, that's why we ask those questions, because it's like, but it really is that complex in a sense. Or there are more options. I could always think of, okay, you have a fixed rate, then you have a variable rate. Okay, decide what you want to do, right? Or an ARM, which is an adjustable rate mortgage. Do you want to lock it in for 5 to 7? But there are all this sort of back behind the scenes activity that's there that the general listener, whomever, might not be aware of.
Absolutely. And a broker a lot of the time is paid by the lender. They'll offer a slightly higher rate, and the lender pays points to the broker on the back end that the client doesn't see. So these are some alternative ways that people are paid in this industry. But there's a lot of money in this industry as well as a direct lender like myself in servicing. So if we keep that loan, like I said, at one point we were keeping about 40%. Right now, with the ups and downs of the market, I don't even know where we're at. A lot of people sold off servicing to become liquid now because it's not strange to anybody that lenders are kind of hurting right now with the climate interest rates, and Fannie Mae and Freddie Mac do not allow direct lenders to claim an unprofitable quarter for 2 quarters in a row. So that's why you see a lot of these large banks now selling off their servicing lenders like us, so you can appear liquid right now, so you don't have to claim a lack in profits.
Well, yeah. So let's broaden the conversation into that. So so now we're dealing with our first rising interest rate environment in close to 20, almost 25 years. I mean, we're seeing, like, Keith and I on our side, we're seeing annuities and CDs and bond rates that we haven't seen since we started.
5.25%. Yeah. It's insane.
It's absolutely. So obviously, that's on the savers end of things. But let's
great
talk
for
about
savers.
Right, exactly. Absolutely, especially if you're conservative and you don't want to put any money at risk. And I love it because, and not to digress too much, but for, again, 20, 25 years, in our world, again, it was TINA, in the sense that there is no alternative when it came to stocks.
Sure.
So people would be like, okay, what rate of return do I have? Everyone would put money into equities because there was no alternative. But now, after 20 years, there is an alternative for the savers. But now let's talk about borrowers. Let's talk about people that are either buying a new home or refinancing or whatever that may be. I mean, at the end of the day, how do you
navigate this?
Yeah, exactly. How do you navigate that? Like, what do you tell your clients in a rising interest rate environment?
Sure. This is where I wish I had.
Is there like a strategy? Like, do I buy now then expect to refinance in 2 years? You know what I mean? Like,
so this is where I wish I had a crystal ball, but this is where expertise.
I thought you brought it.
I know, right? No?
This is where kind of I don't want to use the word expertise, because we are in kind of unprecedented times for variable of reasons.
Yeah.
One, people got used to 2 and 3% interest rates. Well, that happened because we had a pandemic. I mean, unless we have what's truly a national disaster again, the likelihood of 2 and 3 interest rates is close to zero. I mean, we shouldn't have been there. That's not a healthy industry for us to be in. I mean, was it nice for people? Absolutely. But what does that do now? We have people in their 40s, 50s, 60s that are sitting on 2 and 3% interest rates that never want to leave these.
I was going to
interest
say
rates.
they're going to be pretty hesitant.
So our new buyer now became
Right
became the ages of like 26 to 35 years old.
Right.
You know, and these are people who didn't own a home or now
maybe
just
can't
getting
even
into the
qualify.
market. Yeah.
You know, maybe they don't show enough, income yet to even qualify.
And that's absolutely true.
Yeah.
I mean, the interest rates have definitely prohibited what people qualify for.
Sure.
There is a bright side to all of this, though. We've seen this before. Whether it's the Fed's raising interest rates, we know that inflation has to be combated by mortgage interest rates.
Mm-hmm.
The mortgage industry is probably the second driver of our economy in the United States. So what that means also is while interest rates have to rise to combat inflation, we need to rebound the mortgage industry at some point too. So when we come down from this inflation, we need to beef up our mortgage side again, and we need to give people incentive to buy. And
is that in the form of like tax credits? Or, I mean, I'm
no,
sure there's lobbyists.
Usually with interest rates.
Okay, I see what
So
you mean.
usually
Okay.
at the end run of
Of a time like
a
this.
recession,
Sure.
as a whole, interest rates get very appealing
Yeah.
to spark the economy again and
Sure.
drive the economy. Right now, you mentioned bonds earlier. Mortgage rates are primarily driven by the 10-year Treasury.
10 year, okay, that's what I was going to ask about because, anytime, and so this might be on the mechanical side of it, it's like, okay, the Federal Reserve is raising its short term, like it's almost its lending rate, but that's a very short term end of the yield curve, like i.e. very, very short term bonds. But yet mortgages are 10-year, they're tied to the 10-year, even though they're 30-year notes?
Correct, the 10-year Treasury, because the likelihood somebody is holding a loan anymore for 30 years is very, very minimal.
Got it. Interesting.
So primarily off the 10-year Treasury. So
Okay.
unfortunately in our industry, sometimes bad news is good for interest rates. When that 10-year Treasury falls, interest rates fall.
Yeah.
Which is good for us.
And I was gonna say, and how quickly does it respond? I mean, like if someone, let's say you're tracking the 10-year T-note,
Sure.
right, on a daily basis. I mean, how quickly would mortgage rates respond to what the 10-year does? Is it like a 2-week lag, or is it moving?
We're talking multiple times daily.
Oh, get out, really?
No, we're on real-time pricing.
Oh, wow.
Which is really, really good.
Yeah.
Kind of on the contrary of when the Feds raise rates. It's a common misconception, like Feds raise rates today, so they quoted me 6.5 yesterday, and now I'm at 6 3/4 today. It does not work that way. The mortgage industry is highly predictive and highly conscious, and what's the word I'm looking for here?
Forward-looking.
Yes,
forecasting.
Forecasting, and usually being very conservative. So if there's indication the Feds may raise rates, that's already priced in 30 to 60 days prior to that Fed meeting.
Yeah.
Even if they don't raise. So maybe rates will go down that day. Right. And most of the time what we see is Feds will raise rates, and then the next day rates will go down a little bit because we tend to overcompensate in our industry. Because nobody wants to undercompensate.
Right. Yeah.
Right,
Stop
exactly.
holding back.
Exactly.
So, no, I'm sorry to interrupt, but let's say, so now is it new homeowners? I mentioned, you talk about how there are people that are no longer in the field or whatever in the, marketplace because they have some great, 30-year note at, 2.5% or whatever. So, are you still encouraging people to lock in rates regardless? Or are you saying, wait, have you adjusted your recommendations based on where we are?
So I actually adjust my recommendations daily. I have platforms that I subscribe to, pay money to, that, I monitor the market to the best of my ability. There's people better than me out there. And there's people that this is their daily job, is to strictly monitor interest rates and mortgage rates and where they're going hour by hour. Now, while I like to think I'm an expert like that, I also have to dedicate a lot of time to my clients and making sure their loans get to the finish line on time and they're well taken care of. That being said, I have the equivalent to a stock ticker. Mortgage interest rates daily and suggestions whether to float or lock their interest rate. And then predictions as a whole. When are you closing? Are you closing in the next 3 weeks? Do you have a new build that's closing in May? Because there may be different advice for different clients. A new construction now in May, fingers crossed in our industry, April's supposed to be the big month for a lot of things to come to fruition and positive news coming out, hopefully an end run to kind of the turmoil we're in now, and those numbers will be announced May 10th. So,
and what numbers are you referring to? Just like job reports and inflation
reports? Well, everything.
Reports,
inflation reports, job reports, new construction,
okay,
durable goods.
Yep.
Multiple factors, just like your industry, affect our industry.
Mm-hmm.
And when these announcements come out, while they say we're very, very resilient economy, we're also a very skeptical and nervous economy, where any little bit of news, whether it be good, bad, whether it really has a direct impact or not, will sway the market huge right now.
Absolutely.
And you'll see news come out and rates go up, 0.25% today. Well, 2 days later, they're back down. It wasn't really that big of a deal. So, like I said earlier, with overcompensating, while we may be resilient, we're still scared.
Yeah, right. We're still nervous and uncertain. Is another way of putting it too. So pretty much like under normal times, is your business like 50% refinancing and 50% new home purchases, and now it's all new home because no one's refinancing? Or no?
I would say that is a very, very accurate and normal standard of business. It was probably 70-30 2 years ago when rates were at a low.
Yeah.
And it's probably 95-5 purchase to refinance now. Life-changing events are always something that comes up. We're having children, we're having another child, we're family expansion, divorce. So there are circumstances that are always out there, no matter where rates are at, that are going to trigger refinances, state buyouts, people pass, things like that. It's strictly pretty much purchase now.
Yeah, and how is it in Massachusetts? How's inventory? What's the lay of the land?
So there's a major lack of inventory, and maybe it's some of the people who would have sold that are sitting at those 2 and 3% interest rates right now. But we also have kind of a late spring in Massachusetts. We never know when that last big snowfall is going to be, and spring market predominantly is pretty hot in the state of Massachusetts, where inventory comes on the market. Just last month, I think the United States as a whole was around like 680,000 listings, which is well under any other market in the past 3 to 5 years. We're hoping, and we're very optimistic. I'm an optimistic person. I'm hoping for those lower rates in May. I'd love to see sub 5 again. But I do think there'll be turnover this year. I think spring market will tell a lot moving forward. We're hopeful on like I said, inventory coming on. I can't predict, but it's going to be huge because we have a really, really strong job market in the state of Massachusetts, and stronger than what I've experienced in all the other places I've lived, due to the tech, the biotech, the medical, the colleges.
We have
huge tech companies that don't have to recruit from other states. They can recruit from right here. So that job market is always going to spark a housing market, especially Boston, surrounding areas of Boston. And these people need some place to live. And while usually a recession triggers lower rents, that really hasn't happened in the state of Massachusetts. I mean, rents are still stable or on the rise, which is kind of an anomaly from what we're used to. So I do think, and I'm hopeful, like I said, of some more inventory coming on the market.
Well,
We've seen it the last couple of weeks, which is good.
Okay. Well, I'll say certainly fingers crossed, to say the least. And then I'll sort of let you pitch a little bit to Main Street Home Loans. Besides what I think of, or maybe let's say Keith and I think of, like you have your variable rate, you have your fixed rate type of loans. Are there any other funky loans? Like I hear about construction loans and jumbo loans. I mean, reverse mortgages. Those are just all these things that people hear about. I mean, are they under your umbrella, or is that something that obviously I'm sure you work within the industry, but just to kind of tell us a little bit more about exactly where Main Street kind of really focuses, if you can share with all of our listeners.
So as the market constricts and interest rates are on the rise, and sometimes regulation tightens up, we're lenders, and this is what we do for a living. So what we do is adapt, and we come out with new products to compensate. And that's one of the positives when you go through something like this, are new products coming to the market to serve people who are in need of them. I mean, we have debt service coverage ratio products, which is not quite a stated income, but if you're buying an investment property and the rents cover the mortgage and you have a pretty good down payment, 20 to 25%, we don't need to look into your income and your tax returns. The project relies on the self-sufficiency of the property itself. Adjustable rate mortgages are a great way to combat higher interest rates in the short term. While we can't predict the future, they're a good option. Now, I don't think they're quite where they need to be, this is a great difference between the 30-year fixed and the adjustable rate, because the Fed's whole purpose of increasing interest rates is to combat inflation.
Right.
If you're offering smoking rates on an adjustable rate mortgage, it's working contrary to the purpose. So that's why you won't see a vast difference in adjustable rate mortgages to the 30-year fixed right now. We do cross-collateralization on properties. So Massachusetts as a whole is a very difficult environment to sell a home and buy a home as a contingent offer on the sale of my home, because there's so many buyers out there right now with a lack of inventory. You're up against people who don't have to sell a home. Right. So we can cross-collateralize both properties if you have equity in that property and you don't have to make a contingent offer. Yeah. We can do home equity lines on your existing property, so you can go in and buy non-contingent on the sale of your home, as long as your debt-to-income ratio can effectively cover both properties at the time. And these are things we evaluate on our end. Jumbo loans, we have a wide array of different products. And I don't want to go...
Jumbo loan is what?
Yeah, I don't want to go into too much detail. But
it just means for a bigger property, right?
It does. Fannie Mae and Freddie Mac
back
conventional loans. That's what a conventional loan is. And they set the standards, and each county has its own loan limit. So anything over what they're comfortable and what the county loan limit says they're comfortable to make it a conventional loan becomes a jumbo loan. Yep. And that is serviced and held by whoever the investor it is. We probably have 20 of our own products. We also offer, your top 20 banks products. If you come to me, I can offer you, Wells Fargo, BB&T, Truist, a wide array of different products, and each in its own has its own caveats. No two are the same. As a conventional loan has a set of guidelines that you fall into this category, each non-conforming jumbo loan pretty much has its own different set of rules and qualification standards. So, yes.
Well, I mean, that's the thing. That's my point. So, Nate, thank you so much again. So it's Nathan Hartseil from Main Street Home Loans. Again, thank you so much for joining us. Because
thanks so much for helping our clients too. You've really done a good job with a lot of them. Like, the feedback I get's amazing.
Well, thank you guys. I I noticed, right when we kind of met each other, and I became a client as well of SHP. I have this this in my mind kind of ingrained, and maybe it's from the military days, to offer a truly white glove service. I realize that I'm not the only guy on the street, and while this downturn in the market, 40% of loan officers didn't renew their license this year.
Wow.
So competition became a little bit less.
There we go.
I realize that I'm not the only game in town. So I need to offer something different. And I offer something to my client that, in a fashion I want to be treated, and which I definitely see, the differences in how you guys treat your clients, that complete white glove service. Because if I'm going to send a client somewhere, I want them to be treated how I know I would treat them. And that's hard when you're not the same company, and it's putting a lot of faith and trust in somebody else. And I love sending clients your way, and I really appreciate when you recommend me to your clients. Sure. Because I definitely try to go that above and beyond with that service.
Yeah.
Well, certainly not just the service. Obviously, it's also just your knowledge. I mean, when it comes to how complex the whole mortgage industry is, it gives you a good idea that you need someone in your corner that understands it all, that is, kind of rolling with the punches too, because clearly, especially in this environment, it is changing daily, per what you said earlier.
I'm flattered, but it is only mortgage banking. It's not rocket science.
I don't know. Some of the stuff that you were saying was a little bit, very
technical.
Exactly. It's a great way to put it. Thank you, Keith. But I certainly want to, again, thank you so much for coming out. It was obviously a huge for our listeners as well as, for our clients, to say the least. And certainly, too, we'll put up any type of contact info necessary, here and there. But I certainly want to thank all of our listeners as well for tuning in. Hopefully you found it as interesting as we did, and certainly as helpful. Because at the end of the day, that's what we're trying to do. Provide good information, make everyone as an aware and a smart consumer as possible, to ask the questions that need to be asked, and to understand how all the moving parts work. Because the more you understand, just the better decisions that you make. Whether it's about applying for what mortgage, or about how to invest, or whether it's an income plan, tax plan, everything that we do every single day. The more you understand it, again, the better decisions that you make. Nate Hartseil is obviously part of that process as well. So again, thank you all for listening. Again, thank you for joining us today, and stay tuned for our next podcast.
Thanks for listening to the Retirement Roadmap podcast by SHP Financial. If you've enjoyed today's episode, be sure to hit the subscribe button so future episodes are automatically downloaded directly to your device. And if you've liked what you heard, please share the show. Create your own little ripples so we can help even more people with their retirement goals. If you want access to all past interviews, including notes, resources, and exclusive content from SHP Financial, visit shpfinancial.com/podcast. Thanks again for joining us on the Retirement Roadmap podcast. And for all the attorneys out there, and disclaimers and disclosures, I'm just going to put on my super serious voice and add our own. No statements made during the Retirement Roadmap podcast shall constitute tax, legal, or accounting advice. You should consult your own legal or tax professional on any such matters. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk, and unless otherwise stated, are not guaranteed. Our investment advisory services are offered through SHP Wealth Management, LLC, an SEC-registered investment advisor. Insurance sales are offered through SHP Financial, LLC. Our advisors and insurance reps may offer clients advice and/or products from each entity. No client is under any obligation to purchase any insurance product.